use the Australian dollars as the daily chart. And the first thing you want to do is you want to break your market up in reference to time. So now we have the look back of 20 trading days, 40 trading days, and 60 trading days. We can go back all the way to the 60 trading days, and you can see that the lowest point with the old low noted and the highest high formed in the last 20 trading days, that is our total 60-day trading range. Splitting that market in half in reference to its old high and its old low, we can see where the premium and discount market ranges exist. If this old low is violated, we would have to go back and look at the old low formed in the 60-day look-back period. The arrow delineating the lowest low in the last 20 trading days. If that is violated and traded below, we would go back not to the 40 trading days because there's no lower low. The next lower low or discount PDA exists in the 60-day look-back, and those lows are noted respectively. The last 40 trading days, you can see the range is defined by the highest high and the lowest low in the last 20 trading days. So when we look at the last 20 trading days, we do is we think in terms of the PDA matrix. Now what I've done here is I've overlaid the actual matrix. Now you don't need to have this much information or try to have this in your price action, but I'm giving you a graphic depiction on how I internalize and I interpret price action. So if we see where price is right now at Friday's close of the week of this recording, market price is defined as Friday's close, and we would be looking at the highest high and the lowest low in the last 20 trading days. That's our first look back period of 20 trading days. We start looking for bearish mitigation blocks in the premium range, a bearish breaker, liquidity void, fair value gap, bearish order block, rejection blocks, and or an old high or old low. Below market price, we identify any bullish mitigation blocks, a bullish breaker, liquidity void, a fair value gap, bullish order block, rejection block, or an old low and or high. With that in mind, what I've noted is in the last 20 trading days, these are the respective premium and discount PDA in the last 20 trading days. Working our way from the top down, we have an old high, a rejection block, a bearish order block, mean threshold. That's the three up candles that ranges of their bodies, highest high and lowest low in terms of the bodies, not the wicks. That's the mean threshold or midway point. Then we have the bearish order block. And then we trade down into the discount area. We see a bullish order block's mean threshold, the rejection block, and then finally the old low. If we move down into a 4-hour chart, you can see how these PDA give you much more detail. You can start to see how price moves from one PDA to the next. The market for the Australian dollar made a higher high on Tuesday, failed to make a higher high and trade higher into a monthly range as I had expected in my analysis. You're going to learn that having these understandings of short-term trading, it's not required for you to know all the time exactly where the market's going to go. If you fail in your analysis, it'll give you an immediate reason to maybe reverse your analysis and take the trades in the opposite direction. This was the case this week in our mentorship. Originally, I was long or bullish on the Australian dollar with the expectation of a larger price move. It failed to do so on Tuesday. Once Tuesday broke down, as you'll see in the later slides in this presentation, we have a lot more analysis to suggest the price was going to trade down and close the liquidity void. Now again, this is a 4-hour chart, so if we saw price fail on Tuesday and break down lower during Tuesday, we start looking for bearish ideas inside of the premium range. So we look for all of the premium PDA to start keying off of potential sell scenarios. When we sell short on the daily PDA in the premium range, we will be looking for a lesser time frame to target our exit. That would be in the form of a 4-hour or 1-hour chart. The 4-hour here shows a clear liquidity void as outlined here. The price also trades back up into a mitigation and breaker, trades up to an institutional price level 76.80. And while we're not necessarily needing the actual high of the week, we can still take participation in the market move because we understand that the shift in order flow has now been moved to bearish. So we will be looking for discount PDA below market action. At 76.80, we were in the premium range. The void closes and takes us into the discount range. Notice that in the shaded green area. If we further refine this into the days of the week on a 4-hour chart, you can see how this clearly came down and closed in the liquidity void right to the pip. If we add our market maker manipulation template, forming the high of the week on Tuesday, trading at an old monthly, weekly, and or daily high liquidity pool, that's what we saw on Tuesday. It traded slightly above Monday's high, rejected it. Once Tuesday broke down, the likelihood that we would see lower prices was in effect why I said we could start looking for shorts at 76.80 with the objective of 76.05 as our downside objective. That was framed as we see on our market maker manipulation template. The discount market PDA is going to be used on a time frame lesser than the premium liquidity pool that was used. So the daily high on Monday was violated on Tuesday. That's a liquidity pool raid on a daily high. If that's the context, we're going to drop down to a 4-hour and or a 1-hour chart to look for a discount PDA. It comes in the form of liquidity void, taking us down into 76.05 was our objective. Everything tied together, we get a combination of elements of time and price blending and using the market maker manipulation templates in accordance to our market profiles that we used and learned in lesson 2. We get a symmetry in the marketplace that would otherwise probably escape everyone else. So hopefully this is example and understanding and using an example we used in live analysis this week. While we were initially wrong in our expectation of a higher breakout on Aussie dollar, that failure swing on Tuesday gave us insight on how we could change gears and get short on Aussie dollar, even while it traded in sympathy with the weaker dollar, which isn't typical. Blending the two, time and price, it gives us the ability to work within the same parameters that the algorithm will at the interbank level. Hopefully this has been insightful to you. We'll build more on these ideas as we go through and trade with more insights using the IPDA data ranges and PDA matrix.